if you're buying a 30 unit deal and market that you don't live in, I think you're a little nuts. You've got to buy a big enough property where it supports the full-time on-site staff, because if not, I think it's a recipe for disaster. But it's all about the building that team. I was looking to expand outside of DFW, and I was like looking at a map, and I drove to Oklahoma City just to check it out, and then back. And so, it's a 2-hour drive one way. If I'm willing to drive 4 hours in a day to go, visit properties, then, what happens if I just get on a plane? And so that really opened up the options. So we bought properties in Colorado and Ohio, and, kind of all on the fairway and off the fringe. So.
You're listening to the Gorilla State Investing Podcast. We're not here to bruise your bananas with guru sales pitches, overrated fluff, or any other kind of monkey business. We simply provide the ground-pounding truth about what it takes to be successful in real estate.
All right, welcome back to another episode of Gorilla State Investing Podcast. I am your host, Brandon Magierowski. And today I have a very experienced real estate investor. He's been at it since 2010, Kenny Wolfe. Kenny, welcome to the program.
Thanks, Brandon. Appreciate it.
All right, real quick, Ken, I'm just going to do a brief introduction for our listeners, and then I'll let you kind of elaborate on your entire background in real estate and even before real estate. So just let everybody know, Kenny's been investing in multifamily real estate since 2010. He has been involved in over $130 million worth of commercial real estate transactions throughout Texas, Colorado, Louisiana, Oklahoma, and Ohio. His alma mater is Baylor University, University of Texas, bachelor's from Baylor, master's from University of Texas. Kenny, can you elaborate a little bit on that brief introduction, just your background, where you're from, and kind of what you're up to this past year of 2021?
Yeah, sure. So I think those stats are low. So we've acquired over $335 million worth of commercial properties. We've bought over 7,000 units now across 5 states on the multifamily front. Still buy that bio. 15 million. I know, I do.
Well, that online bio.
Yeah, we got a new website, so
okay, good.
It should be updated.
So now, 335 million and 7,000 units.
Right. Yeah.
Good deal. That's awesome. Okay. Keep going.
And then on top of that, so about 4 or 5 years ago, I added 2 different arms to the company. So we went out and started a little fund, bought some Dollar Generals, Family Dollar Trees like that. And then kind of fast forward to today, we've closed out our 3rd fund, raised $10 million for that. But at the end, by all 3 funds, we'll have almost 30 stores across 11 states. And everything from CVS to Walgreens, Dollar General, Advance Auto Parts. We're buying our first LA Fitness this week and outside of Orlando, so that'll be good. And then the other arm that we added was our development. So we do both ground up development of multifamily. We got 2 projects going on right now. And then we also have 4 office buildings that we're converting to multifamily. So we have 2 in downtown Cleveland, 2 in downtown Atlanta. And it looks like we just picked one up in downtown Fort Worth.
That's awesome. Okay. Who is we? When you say we are acquiring, the Dollar Generals and the CVS and doing triple net leases and ground up development, who is we?
We is our awesome team here at Wolfe Investments. So we've got a growing office staff here that take care of all 3 of those different arms for us, managers of each. And then obviously we couldn't do what we do without our awesome investors as well. So.
And when you say your investors, are you I know early on, in syndicating apartments and buying commercial, and you're going after investors, you're doing a lot of 506B deals, and then you graduate to the 506C, and then you graduate to the fund. Is that the path that you took?
So we're still B. I tried one C in my life and I didn't like it, to be honest with you. Really? And our investors didn't like it. So
why is that?
So the 506C, right? So our investor list, at least 2 years ago, so this is 2-year-old data, was 30% sophisticated, 70% accredited, right? So by going 506C, we right off the bat orphaned 30% of our investor list. We did not make that up by talking about it on podcast or Facebook or anything like that. So that's why I didn't like it. It was harder to raise the money actually than it would have been if I did a B. Our investors didn't like it because there's extra steps they have to do. They have to get third party verified that they are accredited. It's just a little bit more of a pain for them. So they're happy with the Bs. I'm happy with the Bs. We'll keep doing the Bs for now.
That's awesome.
And we do the only reason why we do a fund for the triple net is really is to de-risk it. So it's still a 506B offering, but it's a fund setup, equity setup.
All right, let's dive into that because selfishly, I'm going to learn a lot about this. Okay, so you said that, excuse me, use the fund for the triple net lease properties, correct?
Right. Yeah.
Okay, can you explain just explain triple net lease proproperties to
Sure.
me
Yeah.
and to the listeners.
Okay. All right. Good. Yeah. So triple net's the dream, right? That's what everybody wants. And so it's imagine your Dollar General or your Walgreens, your local neighborhood. Well, if it's a triple net store, they fix the roof for you. They fix the toilets. They do the flooring. They do like anything that goes wrong with the asset. They do the day-to-day operations on there to keep up the upkeep. They also reimburse you for property taxes and insurance. Some tenants have their own insurance, and so we have to buy umbrella, which is super cheap, but just to cover the bases. But sometimes we have to front the insurance and they pay us back. But anyways, they always, so it's a very the cool thing about triple net is it strips out the operational risk. We love multifamily, but the downside is that we have to chase rents and we have to fix toilets in multifamily. Right. We don't have to chase rents here and we only focus on, high credit tenants. And the vast majority of them publicly traded. Those companies guarantee our rent. So we know we're going to get rents that's coming in. And then we know our expenses because our expenses are basically umbrella insurance and our mortgage. That's our expense on that income statement. That's it. So it's very easy. It's true mailbox money. The downside to triple net investing is the good thing is that we have long-term leases from publicly traded companies. The bad thing is that we have long-term leases from publicly traded companies. So our leases don't reset every year like they do in multifamily. So we can't capture some of that rent gain. A lot of times we have rent bumps built in there, but it may be shallow of what inflation is doing right now.
What's the average length of those leases?
We buy from 5 to the longest we bought is 14 years. We've done a few that were like 2, but we've only done that 3 times, and it was because we bought it at almost a 10 cap on those. And then while I was under LOI, we called we have contacts now at Family Dollar, Dollar General, those folks. So we called them up, said, "Hey, are you guys going to renew this lease?" They said yes each time, and then we said, "Okay, well, we'd like to do an early extension with you." So we basically pre-negotiated an early extension before we even put the deal under contract. And then one in particular, as an example, Arlington, Ohio, that was a Family Dollar there. We did that on. We got it reappraised and a refi at a 7.5 cap. So basically that fund, is in that full dollar store for only $50K. We pulled out a lot of equity out of that that we used to buy it.
So I can see the benefit from you and your investor side of, owning the property, but not having to basically manage the property from, fixing toilets to fixing roofs and utilities and all that. So what's the benefit for the Dollar General and the tenants coming in if they have to operate their business and take care of the entire building?
I really think it's an accounting thing. So because they're publicly traded, they don't like to have that real estate on their books. So I really think that's what it is. I think the Sarbanes-Oxley, I think, really did that.
Yeah.
But I mean, almost all of them don't own their own real estate at this point. So I think that's why they do it.
So you're basically sourcing an empty building that you would say, and just like you're buying like a multifamily, you're going to buy in really, really strong markets. You're going to do market analysis. You're going to find this empty building and be like, oh, that would be perfect for.
Well, they're not empty. Yeah. No, they're not empty. These are these are existing leases. We close, we get instant rent on the closing statement. And then the next month, the ACH comes in from Advanced Auto Parts or whoever. Right. So,
okay.
So these are, no, we're not doing that. These are existing leases we're walking into.
You're basically buying the property from another owner that has an existing lease in place.
Exactly. Yeah. Okay. Yeah. So we're cash flow positive, day one when we buy it.
I gotcha.
And that's the cool thing. So we do monthly distributions on these assets, whereas we do quarterly on our multifamily because these are so stable on the cash flow front.
Yeah. Okay. So without giving out obviously too much information, because sourcing deals is such a big part of this game, is where are you sourcing these deals from? For multifamily, we're sourcing from brokers to online on market deals, getting on email lists, trying to get off market deals through sellers. What's the strategy with Wolfe Investments to get into these triple net leases?
Yeah, I mean, so as with any kind of new investment you're getting into, your first few are going to be on market to prove you're a buyer. And then once you do that, you start making those connections through brokers, or they start believing in you. Enough to send you, off market deals or packages like that. So it's really a mix of on market and off market, just like multifamily. But when you get started, you've got to take down one or two to prove up you're a real buyer.
Okay. And with the investors coming into these properties, what's the minimum investment that you're generally starting out with for these your investor pool?
So the first three funds, and we've closed them all out, was the 25K minimum. We're going to a 50K minimum on this next one that we will be launching here in a couple weeks. And it's really just because we've had so much more demand now. As a multifamily investor, I was 6 years into doing multifamily when I put together this first fund, and it was like pulling teeth to raise money because no one really seemed to understand it. And so I had it, and I think they thought I lost my mind buying dollar stores, so I'm pretty sure. So I think we only raised like $1.7 million for that first fund. I mean, it's laughable because at the time we were raising $3 to $5 million on a multifamily deal in like 30 days, whatever it took to raise the money. Right. So, this one was $1.7 million in 12 months. The second fund was 2.9. And then this one, we raised 10 million in like 8 months. So it's really seemed to be catching on. And we've actually had to do a lot of education. So we have a lot of on our YouTube channel about commercial real estate investing, because there's really no guru out there that teaches it. Now I say that, and you'll post this podcast and there will be a guru here soon, but popping up everywhere. But anyways, there's really not one out there that I know of anyways. And so really we're kind of having to educate people a lot on this.
Yeah, especially existing investors, right? The people that were with you on the multifamily side, and all of a sudden you throw this new opportunity in front of them and they go, hold on, what is this? Is that right? Is that what happened?
Yeah. And a lot of it was like retail's dead. Amazon's going to take the world. And I'm like, well, anyway, so there's a lot of questions about that we get. And so we focus on the retailers that are, we call them Amazon proof. So like dollar stores, like those are around as a convenience, right? It's a convenience store with, really is what it is. And so
my wife loves the dollar store.
See,
she loves Dollar Generals, but I tell her, I said, it defeats the purpose of the dollar store when you go drop $110 in there. Like you're not right. Like there's no savings there. You're just buying extra stuff. But okay, so I want to kind of hit this fund because all syndicators and investors want to try to get to the point where they're building up a fund to go buy property. Right. So as like I'm putting myself in the investor shoes, and you come to me and be like, hey, we got this fund and we're going to go buy a triple net lease next year. What happens? I put in $25,000 today, but you're not going to close that property, let's say, for 6 months. Right. So what happens to my money between now and the time you actually have the property? Because do I have to give you the money up front? Do I have to wait? How does it work?
Yeah. So we'll kick this new fund off in January. But what we like to do, we'll have 1 or 2 stores already under LOI or contract before we kick that fund off. Right. So we go ahead and basically preload the fund with 2 stores. We haven't closed on them yet, but it should be within a couple of weeks, probably late January, early February, we close on it. So folks that do come in January, their first distribution will probably be either February or March, depending on when we close those. But that first 12 months though of investment really fluctuates. If you annualize the monthly return we give, cash flow return, I mean, it will be between 4 and 10%. And because we've got new investors coming in, that waters down the existing investors, but then allows us to go buy more properties, which everybody owns a part of. So that's why it fluctuates so much based on that. And then we do monthly distributions, and then right around month 12 to 13, whenever we deploy the last of the capital, and they're basically that's when that monthly distribution will stabilize. And this last fund, we got 12.5% cash on cash annually on this first fund. For the first 2 years, we got some IO, and then the next going forward after that, it'll be 10.5% cash on cash.
And are they funded the same way as apartment complexes? A lot of times bridge loans. And is there any bridge loans?
No, I mean, no, it's different lending, right? So it's a lot of regional banks and local banks. It really, I mean, mortgage brokers really pull their weight, I think, on multifamily. I think they're worth their weight in gold. They really work it on the triple net side, because these are smaller. I mean, some of these dollar stores only cost us $1 million. So your loans maybe $650K, $700K, right? So that's that. But we're starting to buy bigger stuff now and getting some different loans. But it's still regional folks. And actually now we've worked out a deal with a regional bank. We've got a $30 million line basically to pull down on for whatever triple net we want to do. So it helps us close faster. We have set terms with that. We can't go 100%. We got to do 75% leverage, 25-year AM. But we get some IO in there as well. We're working with them directly. So we'll probably go through that 30 million pretty quick though on this first fund. So it's really kind of keeping those regional banks on speed dial as you find new stuff.
That's awesome. Okay, let's just dial it back a little bit and just talk about 2021 as a whole. Can you just give us a recap of maybe pick one or two properties where you had some pain points and you solved the problem, and then another one where everything kind of just went smooth sailing? Because I think, a lot of times, even when I'm on social media and looking at videos and looking at Kenny Wolfe and some of these other successful people, everything is just roses, right? Everything, right. Oh man, this guy's killing it. Like this looks so easy. But behind the scenes, we know that you go through the ringer on stuff. You get in the trenches and problems come up. So maybe just use an example, whether it's with a triple net lease property or one of your other commercial properties, of, a real problem that came up maybe during due diligence or during contract, and how you solved it. And
Sure.
Is that a common theme amongst all these properties that you're doing?
Yeah, I mean, so we didn't really have any issues with a triple net. You buy those and they just kind of hum, right? So there's really nothing there. We did have a hurricane do some damage, but that's just an insurance claim, so that's nothing major there. So there's no good stories out of our triple net stores. Multifamily have lots of good stories. Really, I mean, 2021 was interesting. It was still kind of dealing with COVID a little bit on the rental side. Oklahoma was the worst about getting rental assistance out. It just was super slow. So those were the biggest pain points we had to work through on those two assets in Oklahoma City. Was just that was slow to get the rent relief funds out there. We finally got them. I mean, there's still a little bit a few straggling out, but we finally got it. But I mean, it was like 80, 90K on one property that we were waiting on and just waiting. And so that was the deal where I actually lent money to the property, so we didn't have to do a capital call. So we had to do that probably 3 times on properties here during COVID just to get it to where we can get the rent relief and then obviously pay back and no big deal. So that was something we had to work through 2021 still. What else? I mean, it was on our development side, we had to pause to one of our really 2 of our ground up projects because of the lumber issue. When you're in development, your risk are labor, materials, and interest rates. And so interest rates were fine; they didn't move. And labor was a little bit more, but something you could work through. But the lumber, when that shot up, basically just shut down those 2 properties. But now with lumber back down and rents have gone up quite a bit. Now I'm thinking of one in particular here in Dallas, Fort Worth. That project's back full speed on. Lenders are lending a lot of money for development projects again. We just got a 80% loan to cost term sheet that we're working on now on that deal. So
fantastic.
You're right. Yeah, it's a grind. I mean, it's commercial real estate's not for the faint of heart.
It is not. No. And, I went through it early on too. I attended a couple conferences and a boot camp, and they made it, they're just telling you A to Z how to do it. And you look at it and go, well, this looks like, you just follow this book and you can just do it. But it's all about, right, problem solving and relationships and et cetera. But I want to dive in real quick to the markets that you target, Kenny. This is one of my passions is market research, because I made a mistake early on in my investing career on a market, and I figured out, I made the mistake and figured out what can I do to fix it, and it came down to market research. So it says in here, you invest and buy in Texas, Colorado, Louisiana, Oklahoma, Ohio. What are you doing to target the markets?
So each city is a little bit different, right? And so I was just in Cleveland this weekend. We own a little over 1,000 B and C class units there, and do have a few development projects there too. But we're buying another 300 units there or so. So we'll be at 1,300 B and C class units there. There we're still buying for cash flow. Don't tell anybody, but it's still a cash flow town. Cap rates have come down a little bit, but they haven't caught up with the rest of the world yet, right? Although I think this year we're starting to see it. We just got approached twice from some cash offers on our 300 unit portfolio out there anyways in Euclid, but it's just amazing strong pricing, and that's what we're seeing now to Cleveland, that national investors are coming in. So word's getting out. It was nice to be kind of a first mover in the crazy Texan buying in Cleveland, Ohio. Really just because I saw like you, I'm big on market research. Picking on Cleveland, it's got they do horrible marketing because everybody still thinks the lake still catches on fire. There's no jobs, it's the Rust Belt, and if you actually go up there, like there's so much development going on. Sherwin-Williams is building their new global headquarters right downtown Cleveland. Rocket Mortgage is building a new skyscraper in Cleveland. IBM put a new office in, so there's a lot of growth there that really doesn't get a lot of national attention. So I actually had a really big debate with Neil Bawa about Cleveland because he always dogs it in his presentations, right? And I was like, Neil, you're wrong, man. It's not that his data was old and not wrong, right? So that was the issue, right? Because if you pull from City Dash data or wherever, it's probably 3 to 5 years old. And so you've got to be able to kind of, we've been trying to stay ahead, or I have been trying to stay ahead of, hot markets. And so like we were buying in Columbus, Ohio in 2015, and man, I wish I would have bought everything. I can't buy anything now in Columbus. It's so expensive. So I think Cleveland, give it a year or two, it'll be the same way. But so what we've done though now is we still do business here in Dallas Fort Worth at home, but we're either now buying A class or development projects in Dallas Fort Worth. And that's our focus up here now because the market's changed, so we try to stay ahead of the market.
Yeah. No, that's super important. And yeah, Neil Bawa is actually, that's one of the boot camps I went to and learned about the market research and using the data. But you're right. When you use the online city data, it's using census data, which is always, I think it's a couple or 2 or 3 years behind is how it works.
Right.
So stay ahead of those trends. But let's talk about investing in a market that you don't live in. Okay. And maybe dial it back. For some beginners in real estate, a lot of the times you buy your first property in your backyard so you can see it, touch it, feel it, drive there. But it's a big fear to go, Cleveland, Ohio is an unbelievable market, and I could look at all the properties I want. But how am I going to execute and manage that property? So what advice do you have if you're looking to invest in a market outside of your own early on? How can you be confident when you buy that it's going to be operationally successful?
Yeah, I mean, it's a great question. So, my first syndication deal was a 76 unit deal. And I chose that size of a property because I could afford on-site management and maintenance, and I didn't have to do any day-to-day work. You don't want me doing the eviction process. I still don't know how to do that. And you don't want me changing out a toilet. So, but what that really taught me though was it's really, the biggest deal about investing outside your backyard. I live in Plano, which is 30 minutes away from that property, right? 35 minutes. I go to our Cleveland properties way more than I do that Wiley property. And it's because that property is just humming. It's already stable. It's rocking and rolling, right? So it wouldn't matter if it was here or if that property was in, I don't know, India, whatever. Yeah. Because you have the on-site team. If you're buying a 30 unit deal in a market that you don't live in, I think you're a little nuts. You've got to buy a big enough property where it supports the full-time on-site staff. Because if not, I think it's a recipe for disaster. But it's all about building that team. And really, I was looking to expand outside of DFW. I was looking at a map, and I drove to drove to Oklahoma City just to check it out. And then back. And so, it's a 2-hour drive one way. And on the way back, I had this aha moment. It's like, if I'm willing to drive 4 hours in a day to go, visit properties, then, what happens if I just get on a plane? And so that really opened up the options. So we bought properties in Colorado and Ohio and, kind of all on the fairway and off the fringe. So,
yeah, fantastic. All right. Moving into 2022, where do you see, are you going to make another pivot? I know you went from like multifamily to the triple net leases, or another asset class that you're going to pivot to, or are you going to narrow the focus on one asset class into 2022?
We're full steam ahead. We already have 90 million of existing multifamily to buy by February. So we already got that going. Right. We're looking at a few new development projects as well. Another one, or we'll probably have at least one, maybe two more office conversion deals we take down. Some ground up development deal we're working on now and getting that ready for investors. And then our triple net fund starts in January. So, it's kind of full steam ahead on all three. It's nice to have all three because our investors they kind of speak to different investors. If you want, just steady, stable cash flow, you go the triple net route. Multifamily, you get cash flow and appreciation, and then development, all appreciation. But so by offering all three, we kind of meet, most of investors' needs on the real estate front. So I don't see us slowing down. We'll pick the markets a little bit different, potentially as it shifts.
Awesome.
So we'll be out of El Paso probably by February. We've got a property out there that's going to contract to sell. That will be our last property there. So we'll be out of there, but we'll be into Atlanta by April. So trading out some cities as well.
How do you have time to do anything else?
Yeah, it's got a busy
Do you do
schedule.
anything else?
I do CrossFit.
There you go.
And hang with the family and then do this. So it's basically it. I love it though. I enjoy it, but we do keep hiring folks. We've got a big staff here at the office. We just hired another person. Her first day was on Tuesday. So
we'll dial it back to when you started out, because I think a lot of the listeners are, there's some experts, there's some guys just in it for a few years, and there's people that are just getting started out. So, every expert was always a beginner, and there's a path to make it to the level that you're at, Kenny. And
sure.
That's a dream for a lot of people. But dial it back to 2010 when you were starting and you weren't able to jump on a plane. You didn't have an investor base to go to fund deals. Like, what advice would you give yourself, knowing what you know now, and dial it back there? What would you do different? And what advice would you give us?
I spent a lot of time asking folks what they did right and what they did wrong as a syndicator, early on those that first year, really, because I'm big on modeling. I think that's a huge deal. It really shortcuts any kind of learning curve that you have to go through. We're learning things every day, but really it shortens it. So what I found was you want to buy a bigger property than a smaller property. Really to buy that to afford the full-time property management. That's key. Otherwise it really slows you down. You're drug into the day-to-day. And I think it's more risky because you've got I was coming from oil and gas accounting. So I didn't know how to operate these things, so, me operating that property is way more risky than someone that knows what they're doing and has done thousands of units, way more than me. So there's that piece. So that was a good move. And then we did 2 passive investments first to learn the ropes. So one of those was, and I was very, was very targeted at what we invested in. So invested in a big fixer-upper here in Dallas-Fort Worth. The pizza delivery guy wouldn't go to the property. It was that bad. He'd get mugged. So we bought that one. So that was going to teach me, I was looking there to figure out who the team is for a big rehab play, how these rehabs go, what do you have to do, all that, right? And then the second one, key passive investment was a Fannie Mae loan deal. And so what that allowed me to do is my first syndication, that was deal 3 that I did in multifamily. I got a Fannie Mae loan myself on a 76 unit property, right? And so by getting that Fannie Mae card as a passive, it really smoothed the way going forward because, now we've got our, almost all of our loans have been non-recourse loans, for 11 years now. So it's a great tool to have.
What about finding money? What about finding investors? Because, to buy these deals, to buy that 76, that first deal, how did you find the money to do that? How did you warm up these investors to be like, yeah, I'll give Kenny Wolfe my money, even though he's never done this before?
Right. And I did it the hard way without a guru group behind me. So I mean, I basically burned up 2 Blackberries, calling everybody I knew. And then I would take my copies of my, passive checks that I got with me in my briefcase. So if anybody wanted to talk about real estate, I pulled out that check, like, look, this was an honest check. It's a real thing, and then early on, when you're starting out, you've got to really lean on the team behind you. And so, I talked about and it's nice because you have a management company. You can point to them, like they know how to professionally manage these properties where, me coming from oil and gas accounting, I didn't know how to evict anybody or change, all that kind of stuff. I didn't know that. And so by pointing to that team, I was able to really kind of, sell them on the operations side. They knew me as a CFO, as an accounting type, a numbers guy. And so I think that helped a little bit as well. But that's really it. You got to point to the team behind you when you're first starting out.
Good deal, man. All right. Kind of wrapping this up, Kenny, I got a question. This is the Gorilla Estate Investing Podcast. I got a gorilla over my shoulder, and we go to a segment called What Bruises Your Bananas inside of this multifamily triple net lease. So, and all that means is like, what grinds your gears? What kind of makes you upset about what you see inside of this whole thing, whether it's from other groups or investors? Like, what kind of grinds your gears, bruises the bananas?
I think there's a few things, and I pick on them because they're my friends. How we structure our deals is different than most. We don't do upfront acquisition fees, but we also don't do a pref, and we design it that way because that means our company is always aligned with our investors, right? And because we're a 5 to 7 year hold company, we're a longer term hold, a real estate company. Because if you do it the other way, the AC fee, the pref, and the waterfalls, you think about it, that syndicator who's putting that deal together, he gets paid at closing. He hasn't operated it at all. He gets a big payday. He or she gets a big payday. The pref, they're making almost no cash flow during the hold period, and then they make a big windfall when they sell it, right? So that's, if you want to hold real estate long term as an investor, that's the worst way to incentivize somebody. So what we do is no upfront acquisition fee, but we don't do a pref either, right? So it's just a straight 80-20 split. Investors get 80% of the cash flow, 80% of the refi proceeds. So obviously that incentivize our team to really maximize the cash flow, get the refi done as fast as possible, and then hold it long term, for cash flow and tax shield. And then on the sale, investors get all their initial equity back through the refi and or the sale before the 80-20 split kicks in.
That is a investor first strategy. I really like that.
Absolutely.
That really
Yeah.
is. It kind of provides a confidence of giving my money to Kenny Wolfe because he's not taking money up front. It's a straight 80-20 split. Here it is. It's pretty black and white. This is how it's going to work.
It's easy math.
When you get into
like
some of the waterfall stuff, it can kind of get complicated for
Right.
even a sophisticated investor that has never put money into multifamily. Like he doesn't know what a waterfall is and all this stuff. And it's
Right.
sometimes some people hide that information from their investors, and I think that's wrong. I mean,
Yeah. No, I think transparency is key. We're big on that.
Yeah. All right. You said there's two. You said there's a few things that bother you. What else? What else you got? Give me one more. Give me one more.
All right. It really is kind of underwriting, right? So I had some investors of ours. They had to place some money just about a week or two ago before the end of the year, right? So they were scrambling around. And by the way, guys, plan ahead on that. Like if you've got to place money, don't call me in December 10th or whatever it was. Like call me before. But anyways, they called me and said, "Hey, can you look at this deal?" And I said, "I don't like to look at other people's deals because it's a closed community, so I don't like to do it." But they said, "Well, come on, we really value your opinion." So, all right, they strong armed me. So, anyways, they're looking at a deal here in DFW, and they said, and they're commercial developers themselves, are more like strip centers and big, commercial real estate. So they understand this stuff. But they're saying, what do you think about this submarket? Great submarket. I think it's a no-brainer out there. Price per door, feels, okay, not great, but okay, maybe. But but where you see a lot of syndicators cheat are, obviously the easy ones are the rent growth. Like what can you get for rent? And so I said, well, double check that. Do you think the rents are fine? They said, yes. They're probably aggressive, but it's achievable. Not out of the park. How are their expenses? They said they look good. And then what's the cap rate? What's the reversion cap rate? And it was a 4.25 or low fours, right? I'm like, well, okay, so they said with that cap rate, they were getting about an 80% return over 5 years. Which isn't bad. But that's all predicated on that cap rate, right? So I said, well, what happens if you change it to a 5 cap? Because it's not exactly in DFW; it's in the growth path. It's growing, but what happens? They said it's like it was a 10% return over 5 years. I'm like, well, that tells me an answer that I would get from that. I would run. Why would you? It's all based on that cap rate, and that's something I think, because if you change that by a half point, you can make a crappy deal look like a great deal.
And you're talking about from what you're purchasing, the cap rate you're purchasing at, to the cap rate you're exiting the property at. So
right. So the reversion cap rate is exactly is what you're assuming you're going to sell it for, right? So that's a big deal. If any underwriting sheet that you use out there online, you change that one line item by half a point, it changes the entire underwriting. And so that's something that you've got to really be cognizant of as an investor. What did they use as the reversion cap rate? Yeah. So we like to add half a point if it's outside of a major metro area. So we buy in Longview, Texas. We buy in Amarillo. So we usually add a half point from what we're buying it at.
So you say you buy it at like a 6 cap and you're saying a 5.5 cap on the way out, or vice versa?
No, on the way out. No. So if we're buying at a 6, we would assume a reversion cap rate of 6.5.
6.5.
So we add a half, which hopefully we can get our 6 where we're buying it at today. But it really a way to make the numbers more conservative. But in we bought some downtown Dallas A-class stuff, right? Those we just assume the same cap rate because these are core downtown assets. You're not going to see the cap rates fluctuate that much on those just because they're key assets.
Right.
Okay. So it depends on that.
Man, this has been fantastic. Selfishly, I'm learning a lot. So I'm going to be respectful of your time. Just kind of end with this, Kenny. How can people find you? How can people invest with you? What's the best way for them to do that?
Sure. Yeah. So the best way is to go to our website. So it's Wolfe with an E-investments.com. You can find us on all the social media platforms. We've got a YouTube channel. So we put up an educational video every week. And then we started doing some property tour videos, which are pretty cool. We do like a behind the scenes kind of HGTV-ish, kind of look at some of these properties, kind of give people a look and feel of that. We show some numbers on there as well. So that's pretty cool as well. And then we do a lot of conferences too. So I speak at a lot of places, and then we co-host a big multifamily conference 3 times a year. We've got our big one coming up in February in Houston. It's mfinvestornetwork.com. I think all the VIP seats are sold out. So, but we expect about 600 people there. We had 350 in Miami back in July of this year. So we try to hit up the East Coast and the West Coast as well. So we should have 2 more in 2022 beyond Houston in February.
Awesome, man. I appreciate your time, Kenny.
Thank you, Brandon. Appreciate it.
All right.
Thanks for listening to the Guerrilla State Investing Podcast, where we give you the ground-pounding truth about what it takes to be successful in real estate. Learn more at realfocus.org/Guerrilla State Pod.